Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital Lending. And joining me today is Dave Walls, also with Old Capital. Hey, Dave.
How you doing, Paul?
Good. Before we jump into the podcast, I thought, in fact, it's going to be a very interesting podcast because it's going to be with Cornell and Vivian Williams. And they live here in Dallas and just bought a 180-unit apartment building in Arlington, Texas. And they are going to tell kind of, I think, a fascinating story because he's a retired engineer from Ford Motor Company, and she's kind of a serial entrepreneur, and they will tell their story about why they came down from Detroit to Texas to kind of strike gold about owning apartments in and around this area. I think you'll really enjoy their podcast. But before we jump in the podcast, I want to visit with Dave a little bit about what's going on in the Austin-San Antonio market. Dave is a top producer for Old Capital, does a ton of business in those two marketplaces, and I want to kind of give his perspective about what's going on and how business is going.
Paul, yes, the market is still very strong down in San Antonio, Austin, and the surrounding areas. A large volume of business is still being done down there. So, yes, very, very good.
So let's talk about what's the smallest transaction you're working on right now, and what's the largest transaction you're working on right now?
Well, Paul, actually the smallest transaction I'm working on right now is a little 8-unit deal that's being purchased by an out-of-state guy in California. Mm-hmm. It's a small deal.
And how small is small, Dave?
$380,000.
So Old Capital does transactions less than $500,000. That's good to know. And what's the largest transaction you're doing right now, Dave?
We're working on a $35 million construction loan right now in San Antonio.
So that's a new construction transaction. So somebody is building that has a history of building apartments in the San Antonio area that has a good track record. So they're looking to do a $35 million Class A 300-door apartment building. They came to Old Capital, came to Dave to get that put together. So Dave just got the transaction approved to a letter of intent from the lender at a 75% leverage deal, Dave?
That's correct, Paul. 75% loan to cost.
And what are some of the other terms in that transaction?
A 2-year interest-only period with some extensions built into the terms, and an interest rate. Because of the large sums of money involved here, we're able to get a good interest rate, and we're looking at about 3.2%. So interest only.
Yeah, 3.2% during the period of time that the property is under construction, with some additional 1-year extensions when the property gets stabilized. So it's perhaps a 4 or 5 year loan if necessary in the transaction. So if you are thinking about buying a large apartment building or buying a small apartment building, Dave Wall is the person to talk to. And how do people get a hold of you, Dave?
You can email me at dwalls@oldcapitallending.com. That's dwalls@oldcapitallending.com.
All right, sounds good. Let's jump into the podcast with Cornell and Vivian Williams. Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, National Underwriter for Old Capital, Paul Peebles, and of course, always joining me, Michael Becker.
Hey, Paul.
Mike, thanks for spending some time with us today. We have an interesting group in the podcast today. A husband and wife team that's originally from Detroit. They've moved down to the Texas area and have bought numerous properties. And we're going to talk a little bit about what they've done and some learning lessons that they can share with us. So I think it's going to be a wonderful podcast. So I want to welcome to the podcast again, Cornell and Vivian Williams. Cornell and Vivian Williams. And guys, welcome to the podcast.
Thank you. Glad to be here.
Hello, Paul, and hello, Mac.
Thanks for visiting with us. So I kind of want to have everybody meet you and get to know you a little bit better. If you can spend just a few minutes and tell us a little bit about what your background is, what you guys did up in Michigan before you made the venture down to Texas. Cornell, I'll let you go first.
Well, I actually have a background in engineering. I worked for Ford Motor Company really quite some time. I started off early, spent actually 30 years there in engineering. But on the side, we got interested in real estate and started at a small scale back in Michigan. Along the way, I met Vivian, and we grew from small to a little bit bigger.
So, Vivian, tell us a little bit about you guys. What do you guys do professionally back before you started getting into multifamily?
I graduated from the University of Michigan with a communications degree, and then quickly realized that I wanted to be an entrepreneur and started looking into real estate. And Cornell and I actually met in a real estate investment group 27 years ago.
Oh, wow.
And I raised our family, and while we did the real estate part-time in Detroit, and then once he was ready to retire, we decided to get away from the snow and ice and cold and come to Michigan with our two kids and, come to Texas with our two kids, get away from Michigan.
Sure.
And so we knew we wanted to go into multifamily, so we joined another real estate group, Lifestyles, and got involved with that so that we could learn the DFW area.
Pretty much it. Oh, good. So how did you start in Michigan? What were you guys buying when you were up in Michigan? How did you get your start?
I actually started a little bit before I met Vivian. We started off
before we married.
Before we married, but we actually met in a small group there where we pooled our money buying two-family properties. We would buy them, rehab them, and basically rent them. That's how we started.
Okay. Then what made you guys move to Texas besides just the cold? Was that it, or what attracted you to Dallas over say California or Florida or any other place you could have gone?
Well, the affordable cost of living here, affordable cost of homes, the economy was much better. I mean, of course, at that time in 2007 when we moved here, the economy in Michigan was very bad.
Yeah.
So we wanted to find a place that had better weather, better economic conditions, and better atmosphere for investing as well.
Sure. Good. So you guys moved here in 2007, and then when did you guys buy your first multifamily property here in Dallas?
We bought our first property here in Dallas in 2009.
2009. Okay. Tell us a little bit about that deal. That was the Hyacinth Apartments, correct? So tell me a little bit about that deal.
That is correct. That was a 1964 property in the Oak Lawn area. Believe it or not, we started off here. We wanted a property. We did not want a property with a flat roof. We did not want a property with a chiller.
And you got both, huh?
And we got both, and we made money.
That's
we
good.
did well.
So you bought that in 2009. So was that a pretty distressed property when you bought it? Tell us a little bit about kind of what the shape of the property was and what you guys did to it.
It was actually a foreclosure. The prior owner bought that property and actually borrowed money to rehab it. And somehow things went wrong, and she ran out of money. When we bought it, it was about 55% occupied. It needed a lot of rehab. Basically, we continued to rehab. It really didn't need a lot of rehab. She got close, but she just ran out of money.
I believe you guys did a new roof and new chiller on the property, is that right?
Yes, we did. We did a new roof, we did a new chiller, and we did completed the renovations.
That's good. So how long did you guys own that deal, and when did you sell it?
We owned that deal for 2 years, so we bought it in March of 2009 and sold it in June of 2011.
Let's talk about just hard numbers. What did you guys acquire the property for? For what sales price?
Okay.
How much in rehab dollars did you have?
We bought that property for $1,580,000. We put about $130,000 in rehab, and when we sold it, I think we sold it for $2 million.
Close to $2 million, 1.97 or I believe.
Wow. And again, how long did you guys own it?
2 years.
2 years.
Yes, and it took us probably a good year to turn it around.
Now, this property, in your mind's eye, is in Dallas. It is in an area that it's kind of an older section, but it's a re-gentrified section.
Right.
And so the property that was right across the street was probably 3 or 4 years old. And where rents on your property were maybe $750, $800 a month, the property that was brand new next door in the same area was probably about $1,800 a door. So to get the same neighborhood, you were paying almost double or even triple the amount. If you wanted to live and play and work around that area, this was an affordable opportunity for you to buy in. So it really was a good property for kind of a good first-timer property where it had the value-added component to it, but it was it had to be stabilized, some work had to be done on the property, and then you sold the property and you distributed the proceeds to the equity partners in the transaction. You then went on to buy another property. Tell us the property number 2. What was that?
That property was originally called Atrium Gardens, and we rebranded it Tuscany Square. It was a 70-unit property built in 1965 with the chiller
You like those
system.
1960s properties with chillers, huh?
Well,
But this one had a pitched roof to it.
yes,
That is correct.
it was a nice looking property. It didn't look like a 65 property.
Sure.
And it's in Arlington.
Arlington, Texas, home of the Dallas Cowboys. Okay.
Right. And it wasn't too far from University of Texas at Arlington, in a real stable area, but the property was distressed and needed a lot of rehab. So initially it was about 70% occupied. I think we took it down after acquiring it to about 50% to
Wow.
kind of clean the property up and bring the tenant base up.
So pitch roof, chiller property, distressed asset. You guys walked in and kind of turned the property around. And if you could look at the property today to what it looks like, it is a 150% success story. You can walking around next to the pool in the center of the property. A lot of people usually with distressed assets will crush the pool or fill it in. This is a crystal clear pool, absolutely gorgeous. You could eat off the deck of the pool, I would say, and very clean in and around the property itself. And you guys have done a fantastic job of kind of putting Humpty Dumpty back together again. On that property, as the first property, did you guys self-manage those properties? Or did you
Yes,
have a
we
management
did.
company manage the property?
Yes, we did. We actually self-managed the first property, the 41 unit we had in Dallas, and we also self-managed the 70 unit in Arlington.
Okay, so you have a little bit of a history of managing properties.
Yes,
So that property you guys still own,
right.
and how's that property doing today?
And that property's doing phenomenally well.
As they shake their heads and have big smiles on their faces, it's doing very well.
Yeah.
We've been doing, I would say, since we actually secondly acquired that property, we've been doing over double digits return since day one. And the property is actually so stable now, we're actually borrowing a maintenance guy from that property at our new property.
Well, we'll talk about that new property in just a second here. So that property, you've done a lot of repairs to the property. You said the University of Texas at Arlington. That's not a student property. That's just market rates property. There
No.
may be 1 or 2 students in the property, if any.
Yeah, less than 1%, I believe. So it's not right on the campus, but it's probably about a mile or so, mile and a half from the campus. So we do get some students, that don't necessarily want to be close to campus.
Sure.
So
So you guys just alluded to, so now you bought a third property here recently, closed on about a month ago, called Cooper Park. Tell us a little bit about that deal and just kind of high level.
well, that one is actually less than a mile from Tuscany Square. It's 180 units, and it is I would say probably a B minus. I'll say a C property right now. We'd like to get it to a B minus.
Yeah, gotcha. So,
And go
so
ahead.
tell us a little bit about physically. So the property has pitched roofs and individual HVACs. So you took a step up in asset quality, it looks like.
Yes.
Definitely, this property, we did take a step up. It's a newer property as compared to the others. They were both 60 properties. This property was built actually in 1979. It's a newer property, has a pitched roof, and has all individual ACs.
That's good. That's good. So was this property distressed when you bought it? Was it pretty well occupied? Tell us a little bit about kind of what you walked into.
The property was actually pretty well occupied. They were over 90% occupied. I mean, of course, we're going to do some cleaning up, but as far as being stable, the property has been over 90% for some time.
That's good. So tell us a little bit about the kind of difference in financing. The first 2 deals you bought were obviously distressed at the time you bought them. So you got those with just regional community banks on the loan, and this Cooper Park was pretty well occupied. So we were able to help you guys get a Fannie Mae loan on it. So maybe kind of tell in your perspective or experience what's the differences between buying those distressed deals versus stable deals, and how the financing kind of changes a little bit.
And what you like and what you don't like about the financing.
Okay. Well, I would say initially when we bought the first property, as you said, it was a community bank. It was an older property, and we did get a loan, but however, since it was an older property, we didn't get the property amortized as long as we would like. So therefore, that was a 64 property. Actually, when we bought the 65 property in Arlington, it was a better term. Actually, we got 25 years, which was a longer term. However, moving up to the Cooper Park, we were able to go Fannie Mae and get a 30-year term.
Good. So that's obviously helps you. Were you able to get any interest only on the Fannie Mae loan?
Yes, that's great for first year. So
first
12
year,
months.
so-
Yeah, we get interest only.
So good. So you guys you got a 30-year amortization and a 12-year fixed rate loan. So that's phenomenal.
At a 4.6,
4.4.
4.4. That's right, 4.4%.
For 12 years, that's great. And it's non-recourse, which is probably the best part about the whole deal. So obviously if the deal goes, Dallas turns into Detroit and no one can lease units, you'll have personal recourse. That's good. Actually, I use that analogy all the time, and it makes sense finally. So
Yes, I certainly hope that doesn't happen, but you never know. Right. So tell us what you like about that non-recourse Fannie Mae loan, what you didn't like about the non-recourse Fannie Mae loan. Let's talk a little bit about the product itself. I mean, you have an 80% leverage transaction. That's hard to argue with.
Right.
It's a non-recourse. It's hard to argue with that piece.
did they let you roll in any renovation or rehab costs of the loan?
Not on this one. Not
okay.
on this one. It was pretty stable and pretty. We didn't need a lot of work initially.
We probably only needed $100,000 in rehab dollars, and that wasn't very great at all. So we didn't really roll in too much in rehab dollars. We talked about the 12-year term. Is there anything that you can think of why? Because you couldn't get that at the beginning when you did the Hyacinth. You couldn't get it at the second property, but now you kind of check the box for experience level and ownership level and management level. And so, but you didn't do this by yourself. You did it with some additional partners
That's right.
that you put together. Difficult to find partners, difficult to find equity in the transaction. Was that the most difficult thing to do, was find the money or the partners?
Actually, surprisingly not. It was not difficult. I mean, it was less difficult than we thought. We actually had probably more offers for investors on this property than we needed.
How many investors do you have in Cooper Park?
26.
26, okay. And then so
Totally.
you guys raised money on the Hyacinth deal as well?
Yes, we did.
So maybe kind of talk a little bit about the differences and the difficulty or the ease of raising equity, 5-6 years down the road.
We actually put forth more efforts raising the money for the Hyacinth, which was a 41-unit property, than we did for the 180-unit property.
It was for different reasons. The timing was different. I mean, 2009 was a lot more challenging, loan-wide. The financing market was different. We were new to Dallas, new to the investors.
Sure.
It was a little bit more challenging. And then, of course, this loan being non-recourse, it was easier to get guarantors.
Sure. So track record matters when you're out there raising money, and once you do a couple deals, world opens up to you, huh?
Right.
So,
It really does.
That's good. So have you had maybe you guys could tell us, share maybe some of the words of wisdom on, what you guys have learned through the process, maybe some mistakes you made that you certainly don't want to make again, any sort of tips, anyone that's listening that is aspiring to own an apartment complex?
I have to tell you a little bit of a funny story. When we bought the Oak Lawn property, we were new to Dallas, and we knew nothing about Oak Lawn. Anybody's in this area, Oak Lawn is a special area. Yeah. And so we were in a kind of a culture shock when we first got there. So it was very interesting, but to be quite honest, it was a lot of fun.
Yeah.
We learned a lot, made a lot of mistakes. We made mistakes probably mainly in hiring people and finding the right people that fit the property. Because sometimes, you want to draw a certain type of clientele and you need that person who can relate to those people or to people in general,
sure.
Who want to live there. So it was kind of interesting when we first got that property.
It's good. So what's the future hold for you guys? Are you going to kind of stand pat for a while? Or are you kind of ready to gear up and do another one? Or kind of where's your head at? What do you guys kind of see going forward?
Well, talk to us in about 2 more weeks. Right now, we are entrenched in this one.
Man, you guys have just kind of taken this property over. It's only been a month
right,
since you guys
right,
closed
right.
in the transaction. I mean, we're sitting in your office here on the property, 180 some doors, pitch roof. This is a nice property. How difficult was it for you to find a property? How many offers did you have to go out to find the one needle in the haystack?
You can answer that one.
That's a very good question. We did put in quite a few offers for different properties. Some we did not go as aggressively after as we did this one, but once we came across this one, I mean, we just had that feel about it being close to our other property and the features about it. But I would have to say down the road, it was probably at least 5 offers.
5 offers?
At least.
I would probably say it was closer to 8.
Yeah.
In the last 18 months, we've been trying to find the right property, for a good 18 months, and it's been difficult.
And the listing agent of the property, why do you think they chose you guys versus XYZ group out of California or XYZ group out of Florida or XYZ group out of Chicago? I mean, why did they pick a local group like yourselves, a little small syndicate?
Mm-hmm.
What sold them on you?
Well, I think it's important, even for the loan, they're looking for somebody who has experience. We knew the area, the submarket. We were very familiar with this area. We've been here 5 years with the other property.
Yep.
We self-manage, and we do it pretty well, I guess.
Sure.
We've done well with it. So, and it's our passion, and it shows. We love what we do, and so.
The lender that made the loan on this property, which is a Fannie Mae lender, before they made the loan onto the property into the Williamses, who are again the managing members of the property, so they're the captains of the ship. They wanted to take a look at how they had done on other properties, and they went to go take a look at that second property in Arlington, which is not too terribly far away from this property. But we went all over the property, looked in a couple doors, and the lender was really impressed in the way that the Cornell and Vivian had managed the property. So I would tell you that one of the reasons why the lender was so flexible with you guys is that they want to back success stories. They've seen what you did on that property that you guys have owned for a number of years, see the quality and condition of the asset. And that means a big thing for lenders because they're envisioning about how when they go in partners with you, because they're 80% owner of the deal and you're 20%, you're the managing member, they're the kind of the silent partner. They want to make sure they get their money back plus a little interest at, what do we say, 4.4% on $7 or $8 million, that they want to know about the quality and the character of the borrower. So I think you guys impressed the heck out of them, and they really wanted to become partners with you on this deal. So Mike was saying is that what kind of rehab are you guys going to put on this property? Anything great?
Well, we've got a rehab budget of a little over $300,000 on this property. The previous owner had started a renovation on the property. They basically had 3 different unit levels: basic, upgraded, and premium. And the premium unit had new appliances, nice tile backsplash, a nice espresso wood look floor. So what we're going to do is follow suit. They've kind of tested the market for us, and we're going to continue that and just take all the units to the premium level first and rent from there and see how that goes.
And that's going to get you what you think is about $75 to $100 more in rent?
Yes. Yeah, we're shooting for $75 to start. And we'll
$75 times number of units on a monthly basis. I mean, that
adds up real quick.
That's a big number
Yeah.
for your investors.
Absolutely.
That's good. Any parting advice for someone who's listening to this podcast for the first time, aspiring apartment owner, anything, that you tell someone that wants to get started in this business they should know?
I think one of the biggest things that we've learned is real estate is not difficult. People are difficult. Yeah. I know you've heard that before.
Sure.
It's a lot of common sense things, and there's just certain things that you just have to be, like, your rental criteria, you really need to stick with tried and true,
Sure.
and make sure that you have a good tenant base, and not to say that it'll take care of itself, but if you take care of those things, it will take care of itself. So, Cornell, you have anything to add to that?
Well, we might add, over the years, we've done investment in other areas, and we would both say real estate is the only area where we have not lost money.
Yeah, that's good. Well, guys, we definitely appreciate your time. Thanks so much.
Thank you.
Thank you.
All right, bye-bye.
Thank you for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitallending.com to sign up for our weekly email updates. We'll see you here next week with another great interview.